We're live, team. It's Monday afternoon. I am crushed. Crushed. Very little to even say. To be honest with you, it's bad. It's bad. It's not good. That is what's happening. What's happening is no bueno at all. We're going to go through this today as much as I can, what we've got. Before we get to that, I mean, we lost 155 basis points today in mortgage bonds. So we tried to cling on to some sort of hope on Friday that tiny little green candle, even though we were negative, would be something to hold, maybe possibly a pivot point. Maybe we come back up to resistance. Nope. Still in free fall, 155 basis points down the toilet. How much is 155 basis points, Derrick? What is the reference for this? How can I know what the heck is going on? Well, approximately, this is not a linear equation, but approximately 300 basis points is about 1% in interest rate. So if you look at just, 300 basis points on mortgage bonds is about 1% in mortgage rates. Look at it like that. So those 155 basis points today. So that means rates went up about 0.5% today. Just today, 0.5%, which means we're up over more than 1% in just the last couple of weeks. And this trend here, this is from the beginning of the year. I just wanted you to see how far we've come. So some kind of idea. It's hard to gain reference for these things because the markets are moving so fast. And you can just see, like, this is the level we were at. I'll just draw it over here at the beginning of the year. This is the level we are at today. That is approximately, let's just say from 109 to 97. That's about 1,200 basis points, which is about 4% by our calculations, which, we were at right around 3% at the beginning of the year. We're right around 7 right now. So that's holding up. Pretty fair math. So today we lost about 0.5%. Or I should say rates went up 0.5% or so, approximately, which means we're really, really, really getting into, high sixes for conventional, even on conforming balance, and into the sevens. I would say low to mid sevens for conventional high balance. VA, FHA rates, high fives for conforming balance, and into the mid sixes for high balance. It's really crazy, man. Clearly something is broken. And what we're going to look at today is just, I've been studying this, been trying to figure it out. I'm just going to kind of show you what I've come up with. This is what I think is happening. And I think there's an article today that really kind of hits it on the head. And you've noticed, if you watch my last few videos, you're probably like, man, he keeps talking about, why is the dollar getting so strong? Why is the dollar getting so strong? This doesn't make sense. This doesn't make sense. This doesn't make sense. And really it's a red flag. The question is just like, what is that red flag pointing to? And possibly how do we remedy this? So take a look at a couple things. Wall Street's fear gauge, highest level since June. This is just the VIX. That's a great photo of a guy who looks scared on the New York Stock Exchange trading floor. But really, we're just looking at the VIX, and the VIX has spiked here, but still not really near even some of the highest levels of the year. So this has a ways to go. And that's part of what has me in sort of a downtrodden mood today. I'm just like, oh gosh, I just take the week off and just go somewhere to I don't know. It just seems like things could definitely get worse. Things are likely to get worse before they get better here. That's just kind of reality. So that's why I may not have my normal upbeat tone. I'm not loving this right now. Not because I've been wrong, because I don't feel like I've taken too strong of a stance other than just let's look at what's actually here. Bears will look and go, see, I told you, but they didn't know. No one said this. Even people who are bearish right now couldn't tell you why rates are going up or why bonds are selling off. So like, just because you guessed right, even though you didn't know why, that doesn't really help anyone unless you actually know what's going on. You just guessed right. That's all. Morgan Stanley sees dollar surge, setting the stage for something to break. And this is really it right here. The dollar getting stronger dramatically. Meanwhile, the Fed tightening, exacerbating that, seems to be taking the pendulum really far to one side, and it's going to break something. What's it going to break? This is what I'm trying to figure out right now. Something to break. You telling me these guys at old MS don't know what that is? Of course they do. If anybody has a contact, let me know. Bank of England says it won't hesitate to hike rates after pound falls historic low. And this is where it really begins. So other currencies, the reason why the dollar has gotten so strong, and I do want to say this at the very top of this, an overvalued dollar, an overly strong dollar, an unnecessarily, unreasonably strong dollar like we have right now versus assets that have been beaten down, it does start to make sense if you're in the position I'm in, if you're cash heavy and you go, okay, well, maybe my overvalued dollars, maybe I should start spending some of those to buy. Because remember, when the dollar gets stronger, everything that's priced in the dollar gets cheaper. Everything. Gas, homes, everything should get cheaper. I have a buddy who just went to Europe and he said that the exchange rate was crazy and everything was super cheap. It's because the dollar's gotten so stinking strong and the Federal Reserve has their head so far up their own asses that they don't even realize it. For some reason, somehow they don't realize it and they're continuing to tighten. I'll explain more about that in a second. But it does make sense to sell overvalued dollars and buy maybe undervalued assets. I don't think stocks are undervalued at the moment, by the way. I do think there's some cryptos that are. I do think there's real estate that is. But it does make sense to maybe start to dollar cost average out of the overweight dollar into some of the underweight stuff. Start to. Not that this is the bottom, but that we should be potentially in this bottoming process. By the way, we're live on Facebook, LinkedIn, YouTube, Twitter. And you can drop your comments. You can say what's up if you have a question about what's going on today. It's kind of a crazy day. This will probably be a little bit longer video. We're going to go into some things in more depth. I want everybody to understand at least what I know, what I've spent time trying to figure out so that we can hopefully solve this thing and figure out when does the turnaround come? What is the catalyst? How could this be happening? How could this be happening? And ultimately, when do we have good news on the horizon? So Bank of England saying, hey, we're going to have to hike rates too. Because think about it. If the reason why, and I'll just put the DXY up here. And by the way, I put a link in the description about what is the DXY index, how's it calculated for people who are asking me about that. I think there you go. But what's happened here is take a look at this. This is the dollar index, which is basically just, how is the dollar performing against other currencies? Remember, every currency, when you look at a value in it, even Bitcoin, for example, you're looking at dollars. You're saying how many dollars per Bitcoin. When you're looking at the dollar index, you're usually looking at it compared to another currency. How many euros per dollar? How many dollars per euro? And so it's always got to be compared to other currencies. Well, the dollar compared to other currencies is getting way, way stronger. Is it because there's something happening with the dollar to make it stronger? No, the dollar is also being weakened, but it's not being weakened at the pace that other currencies are being weakened. So what's happening around the globe is insane, crazy inflation, which makes our 8% inflation look like deflation. That's how much inflation there is going on elsewhere. Meanwhile, our Federal Reserve is not paying attention to that. They're just looking at our own inflation rate because their goal is we want 2% inflation no matter what, no matter what, no matter what. This is the problem with having hard rules and not being able to take a step up away from your desk and maybe loosen your bow tie a little bit and just go, what the hell is going on here? And how can we help the people of America to do better in this situation instead of do worse? That is not the kind of conversation they have. It is the kind of conversation they should be having, but it is not the conversation that they're having. They are laser focused on their academic 2% bullshit. And because they're going to continue to tighten rates and continue to strengthen the dollar, even though it's not helping anyone in any way, unless you are traveling abroad. That's the only situation. It hurts everybody. It hurts companies who have international businesses who have to, they have to exchange currency and they have to report the exchange rate on currencies for other types of currencies that they have and revenues that they've received. It's not good unless you're traveling or if you're in cash. If you're in cash, you like to see the dollar strengthen But look at this. We've actually gotten outside of this already crazy channel that we're in. And what I did here, let me get it off my face. These red arrows here are where the Federal Reserve raised rates. Okay. So you can see they raise the rates, we get a pump. Okay. Maybe a little pullback, raise rates, little pullback, pump, raise rates, pullback, pump, pullback, raise rates, pump. And it just keeps going. This most recent one was only a few days ago, right? And look what's happened, just flying high. Why? Because they're deflating the dollar, which means they're making it more valuable. Even though we have an 8% inflation rate, in comparison to everything else, it's massive deflation. They're continuing to do the wrong thing. They're continuing to be 3 months behind the curve. They're continuing to be using the past to try to figure out what to do now. And they're continuing to use the old rule book instead of looking what's actually going on. This could go on for some time, and that's the reason why I'm bringing this up. This could go on for some time. Is cash king again? That's a big question. Let's see. So other central banks are going to need to tighten just to keep pace. Otherwise, their currencies are going to get absolutely flushed. Now, this is something I'm just going to include in there. Some members of Congress have been above average investing returns. Yeah, you think? There's 2 new ETFs that are coming out that allow you to invest in what the people who are in Congress are investing in. So I just wanted you to have that link. I thought it was pretty interesting. Okay, so let's come back to this. Now we're down 155 basis points. We've seen this huge move. Bonds have sold off massively, even though we're in a deflating environment, which should be good for bonds. So something's going to break. Is it going to be the bond market or is it going to be the currency? I think the currency is what's breaking the bond market. But it shouldn't be that way. That doesn't actually make sense. So, but there's nothing else that does. Unless somebody knows something I don't. Somebody have access to information I don't. So you see this huge move. Now, let's go ahead and let's zoom in a little bit. Oh, oops. That's not what I wanted to do. Get rid of that. There we go. So you can see here some terrible days. 2 out of the last 3 days, big red candle, stall, little morning star, and then boom, big red candle. And we don't have support anywhere, by the way. We are in actual free fall. Rates may continue to get worse for days to come. I mean, there's nothing down there to support it. And clearly the bond market's broken. The bond market in other countries is also very, very broken. We have the dollar surging like crazy. You have oil falling. We've been tracking that. There's the downtrend we've been tracking. We looked at, hit some key technical elements that we looked at last week, and now still falling. Oil falling is always something we want to watch. It is a truth serum for the macroeconomic environment. Oil cannot fall. You cannot fall like this if things are really good globally from an economic perspective. It just can't. There should be tons of demand. There isn't, especially strange heading into the winter. I know it's still warm in a lot of places at this point of the year, but what a perfect time to hedge and get your oil right now. And maybe that's what is going on or should be going on. But if you look at the Dow is the one that's really kind of giving me the, oh boy, we made a new low and we are now below the previous support from back in June. And remember, June was when we were in a situation where inflation was still escalating. Inflation in June, we hadn't reached the peak yet. There was unknown when we would get to the top. And now we're in a place where inflation actually has subsided a tiny bit. It's not at the peak where it was in June. So we've been thinking that inflation was the big problem this whole time. And maybe that's not the case. Look at the Dow, the NASDAQ is holding on to support just barely. The S&P is right on support. I mean, just right on it. And so we got to really hope that the S&P gets a bounce tomorrow, just because if that moves lower, we're really looking at 3,500, which is another 150 points lower from here, at being pretty much a certainty. Now, the stock market, I do believe, remember, we've been tracking this too for quite some time. The bearish horn, those 2 blue lines there, not a good sign. Usually volatility and downside do follow. We've got that in all 3 indices. and it hasn't really played out a whole lot yet. So there could be a lot more downside in the stock market. So be prepared for that. Mentally be prepared for that. Mentally be prepared for what happens to your clients, customers, individuals that you interact with who may be experiencing that. Things may change for some people. I can already tell you right now, rates at this level is going to cause problems for buyers. Rates are already causing problems for buyers. We have more problems now for buyers, which in turn creates problems for sellers. We already have a little bit of issue with the bid and the ask. Sellers will still wanting a little more than what buyers are willing to pay. That distance is going to increase now. You're going to have a greater gap between the bid and the ask. And people who are just putting their home on the market might get a rude awakening for what people are willing to pay. We've seen there's still been a lot of activity. A lot of people want to buy real estate. A lot of people are applying to buy real estate, to get approved to buy real estate. People are going out and looking at houses. Open houses are busy. Things are happening. But where rubber's meeting road and it's time to write offers and get payment quotes and things like that, it's really kind of turning people off. So this increase in interest rates is not what you wanted to see. And I've been saying this for a long time, but the number one thing that we had to be concerned about for this market, the main issue was interest rates going too high, too fast. So interest rates going too high, too fast was the main thing. Look at that. How random is that? So October 16th, 1998, that was my 18th birthday. I randomly have the thing on this. 6.9% interest rate was the average, and we're headed right for that. We are probably going to see on this Thursday, when we get the average rates through last week, we're probably going to see close to 6.5%. The following week, it's for sure going to be higher than that. So we're looking at a rate environment that we haven't seen in a very, very long time. Now, we have seen 6-something interest rates. We did see that in the 2000s a couple times. We saw that, before the crash even a little bit. Here's the big difference. And I want to look at these two things. So when we look back, okay, well, hey, in the late 70s, early 80s, rates spiked up into the teens. They got to 18%, almost 19%. But if you look at real estate values, real estate values just kind of chugged along. It really wasn't a huge factor. You look at that, it's pretty bananas, right? And I've looked at this multiple times and gone, these rates, it's not going to be as bad because look, real estate values, people see value in real estate. We know what happened in COVID. Here's the difference, and this is something that I missed. A variable I missed. Back in the late 70s, early 80s, people were putting a lot more money down. They were also borrowing with a lot smaller loan amounts, so the increase in interest rates wasn't as significant. The more money you're borrowing, the more the interest rate matters. The more percentage of money that you're borrowing and the size of the money you're borrowing, the more the percentage rate matters. So I don't know that we can really use this as a great guide for the situation that we're in. And that's disheartening because it was a very nice little move, just kind of slowly, even through these recessions here, rates going up, we saw real estate values increase. We're still waiting for Q3 number to come out here for 2022. You see the last quarter, we had a jump of almost 2% in real estate values nationwide. And that's a slowdown from what we've been experiencing for sure. But we haven't seen downward movement on this yet. And that's definitely coming. That is definitely coming. So the worst thing right now is for rates to continue to get worse. And this is why we were talking about how fragile we were when we were right here. Like, man, we're in a really fragile position. We desperately need like a bounce here or we're going to have problems. And what do we have? We came down, found a little support, then back up to that area and then rejection. The perfect trade, very simple stuff. And now we're in no man's land in free fall, basically. And I will get to comments and questions in a second. I can see some of those are coming through. We're basically in free fall. So we've gotten to the point where rates are at a point where they're causing problems in the market. We're also in a position where they could continue to get worse, potentially significantly worse, in a relatively short period of time. So that is not good. That is the one thing we've been saying, hey, this could cause problems. This could be really bad. Will it cause a market crash? I still don't think that interest rates alone can cause a market crash. But this other thing, this something that's going to break, whatever that is, we need to know what that is. We need to know what that is, because that, on top of higher interest rates, could cause a crash, whatever that is. If something breaks, if the bond market just breaks, which I don't know how it could with the dollar getting so strong, just makes no sense. This really makes no sense. But if that's what it is, if that's what we're witnessing, if we're witnessing the bond market breaking, a bond market crash, that could cause significant issues. We're obviously going to keep a close eye on this. Let's see. Increase interest rates. NJ, increase interest rates to next year. Yeah. So Jay Powell and our buddies at the Fed are probably going to continue to raise interest rates. Not because it's the right thing to do, not because it is the safe thing to do, not because it's the most important thing to do, but just because it's what they think they need to do. Because to them, getting inflation down to 2% is the only thing that they're focused on. And they're saying that they realize there might be some pain. There's going to be, it's going to be rough to get us back to that. But I don't know that that is necessary, but it's all relative. People are worried about inflation rates, but you also have to look at, well, how is that even calculated? Like, is an inflation rate even important if we have countries that are 30, 40, 70, 100% inflation year over year? We're at 8%. That's not too shabby. We don't really need to tighten in that situation. We can let it chill for a minute. Yes, do what you've already done and then knock it off. You've got it to stop. It stopped accelerating. That should be enough for right now. You could have got it done a lot quicker if they'd done it all at once. But yeah, they're talking about that, and they very well may. They're going to get some pressure here. Okay, there's going to be some pressure that comes with what's happening, and it may take a while. That's the thing. It could take 1, 2, 3 months before we see any kind of pivot. But we need the Fed to pivot. Now, the Fed pivoting would probably do it. I just don't know if we can rely on them to do anything. James Brennis, cash is king. It appears to be that cash is back on the throne. It appears that way. I mean, how can you argue with this? Your cash making this kind of money, and the Fed saying we're going to keep doing more of these red arrows. Those are all these red arrows signify when the Fed has raised rates. So if the Fed says more red arrows on the way, then yeah, cash should do pretty well. But that's part of the reason why I say, okay, how many more red arrows could there be? Maybe they're going to put 1 or 2 more of these up here before they have to slow down, even if they're being complete idiots like they have been. 1 or 2 more of these, and then what? And then sit tight. Okay, well, maybe we get back into this range and still kind of chop higher. Then maybe we kind of go sideways for a little bit. That'd be good. But that would be, hey, that means we're at the top. So that's when you would want to get out of your dollars and into something else. Real estate, I think, would be the best thing to do, just for most people. But someone was asking me today, hey, is now, or what did he say? Hey, I heard rates went way up today. Is this a really bad time for buyers? The guy who's thinking about buying a house, is this a really bad time for buyers? Well, actually, it's a really good time for buyers. But most buyers aren't going to see it that way. Most buyers are not going to see it that way, because when you're financing and you see the payment going up, you think, oh, well, that's bad. One of the things we say in the industry that has really caught on this year because of the quick spike in interest rates is you marry the house, you date the rate. Someone took that a step further and said, divorce the rent, marry a house, and date the rate, which means when a better rate comes along, you take it. Now, it is a good time for buyers. Now, your purchasing power is going to be limited, but you have more opportunity to negotiate, get a lower price, and so forth. So ask yourself this: would you rather have a higher interest rate and a lower price on the home, or a lower interest rate and higher price on the home? I would rather have a lower price on the home, because pretty much everybody will refinance at some point. And there's very few people who don't refinance. And the people who I've actually refinanced for, like, yeah, I haven't refinanced in 15 years. And the people have refined 10 times and I haven't refinanced at all. It's just something with them. Had nothing to do with the market. They should have refied. They just didn't want to for whatever reason. They're scared of paperwork or whatever. So you'll have opportunities to refi, but you can't ever renegotiate the house price. Once you buy it, you got that price. That's your price. And if you got a low rate already, then you probably won't have a good chance. You won't have a chance to refi. But if you get a lower price and you have a higher rate, you have the opportunity to improve the situation. It doesn't help with your purchasing power now. I get it. I do. I get it. But that's just the reality situation. So I told them, it depends on what you want. Do you want to buy a higher price with a lower rate, or would you rather buy at a lower price with a higher rate? All things aren't created equal. I get that. It's not a totally linear equation, but it should help you figure out what kind of buyer you are, because every buyer wants a deal. There's one thing for sure, 100%. Every buyer wants a deal. So what do you consider a deal? Do you consider a deal like getting the greatest rate? Do you consider a deal getting, favorable terms and price? If you consider it terms and price, now's a great time for buyers. More from James. Renter Nation's here to stay. Couldn't sell my house and walk away from a 2.75 loan. Yeah. And a tax rate based on half the value. It's getting rented. It should. Yeah. This is the other thing. Okay. So we're starting to see this inventory declining. Let me see if I can actually pull that up while we're talking here. Pull up the inventory graph. Inventory declining because sellers are just going, you know what? I'm not going to sell it for this. Hell with that. And so if they don't have to sell, they're not selling. And so we're starting to see inventory really dive again. And now seasonally, this happens as well this time of year. Typically, inventory does decline in the fourth quarter, and that's happened. It usually starts middle of the year and sort of heads down. I'm going to pull up. Wow. I'm going to show you this because why not? Let's pull it up. Let's look at it. Inventory. All right. Now let's pull this over here. Okay. Inventory graph right here. So you can see, inventory really taking a quick dive here on the 7-day chart. Was up around 930, 940 homes on the 7-day average, and now down to 788. So pretty big dive there, like a 15% drop off in inventory. And I think we're going to continue to see this decline because sellers just don't want to sell at these prices. But you are seeing cash buyers, investors. I have investors who are firing away at this market right now. I mean, there's some investors out there that are, you call it trigger pulling. They are getting after it. Will it work out for them? Yeah, I sure hope it does. Okay, let's go back up here. Sorry, I got to remove that. Okay. What's up, Mantis? It's called buyer's market for a reason. Have my eyes peeled. We'll be looking to get into a HELOC, getting HELOC out when I see a deal enticing enough. Yeah, that's another thing. People still have a tremendous amount of equity, even with prices being down a little bit. And a lot of people are using that equity to purchase other real estate. It's just really just a market for savvy buyers, I think, is really what it is. It's a savvy buyer market. It's an investor market. If Fannie wanted to do themselves a favor, remember they increased interest rates for second homes and investment properties for conventional loans significantly this year. Humongous. If they just lifted that, you wouldn't even need rates to go down. If they just reversed that and said, you know what, we don't need that on there anymore. That's not an issue anymore. That would lower rates for investment property financing, for non-owner occupied financing. And that would really, really help things. But Mantis, I'm with you. My eyes are on the prize. I am staying laser focused on opportunities here, which are definitely there. Let's take a look at a couple other things here. Market Action Index, 49. That's the lowest I've seen it. Let's see. What was the profile here? It was at 50. Okay. Last month at 49. So it seems to be sort of leveling off there in the mid range. The way this market index works, it's considered a buyer's market once below 30. So still showing that it's a seller's market, but I'll tell you right now, it's a buyer's market. And if the sellers haven't realized that yet, it's probably going to hurt them. I would not want to have a listing right now that hasn't sold yet. What a challenge for realtors in the marketplace, listing agents in the marketplace. What a challenge to try to figure out how to explain this to someone, knowing that if you come in too cold with it, they might just say, well, hell with it. We don't want to take it off the market. And I think a lot of them are saying that. So what do? Keep trying to push, keep trying to get the price the seller wants, and then it goes off the market. Now you've done all this work, probably spent money and marketing and all kinds of things. You got nothing to show. Somebody posted something today. Give your realtor and lender friends a hug today. It's true. It's true. We need one. This is the worst day in a long, long time. I know that for a fact. Let's see. One other thing I want to look at here. Price per square foot. The king of all indicators. And you see, this has just started to roll over a little bit here. It's kind of a rounding action that's taking place here. And this started back in, let's call it February. And it's just kind of rolling over a little bit here from the highs. But you'll look and you'll notice price per square foot for detached homes in San Diego, still around $660 to $675 a square foot. That is not too shabby. So meaning if you bought anywhere prior to, really prior to this year, even in January, if you bought in January or before, you're still in really good shape equity-wise. What's going to be interesting to see here, and I'm going to try to collect some data on this for the next video, is the rental market. Now, one thing I've noticed over here in my neighborhood, that there's been several signs go up in people's yards for rent signs, and not just like the kind you buy at Walmart and stick in the ground, like official realtor serious for rent signs. And my guess is those are people who would have sold, didn't like the way the market was set up, and so now they're going to rent. So if more rental inventory comes in, then that could help soak up some of the potential buyers who were looking to rent but couldn't find a place to rent. They may end up taking that route. So we're going to have to keep a close eye on the rental market as well. But you can see here, price per square foot has fallen off a little bit, not too much. If you look at the overall move there, just going back to, let's see, that's October 2019. That's the move. It's a pretty sweet move. But as of late, definitely flattened out. And the impact of this 155 basis point decline, that has not been felt yet. That is not priced in. So guys, we don't have a lot of good news here. We just don't. We're facing some difficult days coming up. I hope things turn around. I hope the bond market wakes up. I hope bond buyers wake up tomorrow and feel good about the day and decide to come in and push the buy button, pull the freaking trigger. I hope the Fed wakes up, stops doing dumb shit, stops doing the exact opposite of what needs to be done 3 months after it should have been done. That would be great. All those things are things that could happen. It's all possible. But right now, I don't have any indication that we are headed in that direction. I don't have any indication. I don't have anything to lean on. I don't have anything to be hopeful about. Literally, we're in free fall in the mortgage bond market. All you can do here is just try to lock your rate in as soon as possible. If you're in a situation where you're buying a home, I know people who are in new construction situations are not going to buy a home until March. I don't even know what to tell them. Really don't. Okay, let's do 180-day lock. I can tell them that. But the rates are insane. It does give you some sort of hedge, but hedge against what? Come total hell breaking loose? I mean, how much worse can it get? It could get a lot worse, and it could get a lot worse quickly if things continue at this rate. That's a fact. I hate it. That's true, but it is. So while we're waiting for this something to break, whatever it is, and we're watching the dollar climb just insanely high, this crazy rate out of this channel, which was already insane, on the heels of these red arrows here, which are the Fed raising rates, something's got to give. Is this all Fed induced? Is this 100% Fed oriented? Pretty much. Yeah. If there was no Fed, we would not be in this situation. That's for sure. You can point back to them for all of it. From the time when they were buying bonds and rates were at record lows to the time now where they're talking about selling bonds and rates are at highs. I mean, just doing everything exactly wrong. What are they saving us from? Inflation, okay? Saving us from inflation. Is it really inflation if the dollar's doing this? Is it really inflation if homes are going down in value? Is it really inflation if gas is going down in value? What do you call inflation? How do you even define it in this situation? I think you have to take a different approach. You have to take a look. You have to zoom out all the way globally. You have to look at it globally and say, how are we doing in comparison to everyone else? We don't need to meet the benchmark of 2% if 8% allows the dollar to look like this. If 8% inflation allows the dollar to look like this, okay, then we actually need more inflation, probably. And that's crazy to think of. But that's just what the charts are showing us. I don't know, team. Wish I had better news, but it is what it is. I'm going to shoot you straight. I told you, if I see things to be worried about, I'll tell you. And we now see things to be worried about. I was confused at first by this. Now I am concerned by it. And we have seen some of the effects. We have to assume that this is part of the effects of this extreme cascading downtrend over here in mortgage-backed securities. This relentless sell pressure that won't go away, that's causing rates to go up every single day. When will this stop? When will investors look at this and go, that's a bargain? I'll take it. Now think about all the things we've already had go wrong. Yield curve inversion, right? That wasn't good. We've had super high inflation, Fed tightening. We had so many things that are like big time macro things impacting a market. And we're still seeing massive moves. So is there another something coming? It sure feels like it. What could it be? Or are we watching it? Is this it? We thought this was the effect, and it turns out this was the thing. This is it. I don't know, but I can tell you this. The market's going to be tough. Market's going to be tough here for a little while. And everyone should be prepared for that. It truly is a great opportunity for buyers. Most people won't realize that. They won't take advantage of it. Cash buyers are crushing right now. They're going to crush in the days to come. I mean, cash buyers are just, such a good position. And so they're going to be in there hawking. Now, you also remember, we talked about this. I should have pulled this up. BlackRock, $30 billion to buy real estate. This was a couple months ago. How did they know? Are they participating in this? Did they know this was coming? There are a lot of people who are going to buy this real estate if it does go on a fire sale. I can tell you that for sure. And we're not there yet. It may not even happen, but we always pay attention to those things. When BlackRock does something, when these big funds do something, it's always a few months later. It's like, oh, well, that was the perfect thing to do. How did you guys know? How did you know that was the perfect thing to do? How did you know to be prepared like that? How did you know to raise money for real estate back when things looked pretty solid and rates were actually getting better? Yeah. Lots of questions I have for you. Okay. Listen, it is what it is, but now even more so than previously. Important for financing. If you get a quote or your clients get a quote and they're like, man, I'm not really happy with this. This isn't what I was hoping. Let's take a look at it. Let's make sure it's legit. Okay. Let's make sure it's a good deal. Huge advantage we have in the broker world, being able to lock loans multiple times. Like if I got a purchase contract in today, even though it was a terrible day, I would still lock it. Why? Because it could get worse tomorrow. And I have no cost to lock, no cost to break a lock. I'll lock with another bank if rates improve tomorrow. So a huge advantage that we have in this market. And we can help you, your friends, your family, your clients take advantage of that. Give me a call, shoot me a text. I'll be here if you need me. Guys, have a great day.